Welcome to the Market Mondays, I should say. My name is Carl Rodda. I'm with Dani Hathorn. It's wonderful to have your company. Dani, how you going?
Hi everyone. Hi Kyle. Good to be back. I missed last Monday. I was away, but I'm excited to get into it this week. We have a very, very busy week. So let's get through the necessary risk warnings and then we'll dive into it. Big central bank meeting, week of meetings, basically.
Certainly. Well, I'll start with my risk warning. That is to say that everything that you hear here is of a general nature only and it does not take into consideration, I should say, personal circumstances. CFDs are, of course, risky products. So consider your risk appetite before trading CFDs or, Dani, it's obviously spread bets in the instance of UK clients.
Yeah, of course. UK clients, aside from having CFDs, we also have spread bets available. Similar risk profile to just be aware before trading them that you are aware of the risks involved and that you understand the products.
Indeed. Let's quickly run through what we're going to talk about this week. And as you said, Dani, it's mostly about central banks, primarily FOMC, we've also got a few other central banks that we can run through. BOJ, I'll probably tackle it one point. BOE, obviously, Dani, you'll have a good view there. Bank of Canada also expected to cut interest rates. We'll get back to that. But we do have a situation, obviously, where stocks are around record highs still. Gold's similar. A similar case, and the USD is looking a little bit softer. We'll push on. We might get just a little chart up or something of that nature just to set the stage, or at least give you something flashing to look at in the background. But to begin with, Dani, basically we're expecting a 25 basis point move. There is the slim chance, actually, as I might show here now, that we'll get a 50 basis point move, but the probabilities of that has diminished to all but around 3 to 4% when I last checked. Call it 6% at the moment, but all within the normal fluctuations of a day's trade. But of course, the devil's in the detail at this decision, especially when it comes to guidance, forecasts, and maybe even the vote split as well.
Yeah, look, we've said that I don't think there's any division on whether we're going to get a cut at this meeting or not. I think we're well over that point. There was some expectation or a little bit of a small chance that the Fed could potentially push for a 50 basis point cut. I guess it's still somewhat on the table. I think if it were to happen, it would take markets more by shock than anything else, because I think that as clearly we're showing here that the pricing is heavily on that 25 basis point cut, but a lot of it having to do with the fact that the data in the last few weeks, we've had some key data come through from the labor market, from inflation. And it continues to paint a picture of somewhat resilience in the US economy, specifically when it comes to corporate earnings and to growth. But the labor market, of course, softening significantly in the last 2 months, and that's what's given way to this push towards more rate cuts from the Federal Reserve. However, inflation does remain towards the top side of the range, roughly around 2.9%. So almost at that 3% marker, which is, as we're saying, the top range of their appropriate level. So inflation still to some extent limiting that expectation of seeing that jumbo outsized cut from the Federal Reserve. As you were saying, it's less about what happens at this meeting when it comes to the decision on cutting rates or not. It's more to do with positioning and how the FOMC members see future cut rates coming. Markets are pricing in three rates cuts this year, so in the next three meetings, including the one this week, potentially 75 basis points of easing ahead before the end of the year, with another 2 or 3 more cuts next year. It's now a question of whether the FOMC is in line with that, whether they expect that to happen. The previous economic projections that we saw in June, I believe, weren't so heavily dovish. It'll be interesting to see whether that has shifted or not. And as you're saying, the vote split is going to be interesting because we do have some doves within the central bank that we expect to potentially push for a bigger cut this meeting. But we do have a lot of them that are likely to put on, their wait and see cap and just take it meeting by meeting and try to be a little bit more conscious about not cutting too quickly.
Indeed. And I think, as you've just noted, Dani, it's obviously going to be about the rates curve and the direction of travel when it comes to the federal funds rate. And just to toggle very quickly through just the upcoming meetings as well, like you said, markets are pricing in a pretty good chance that we'll see a cut in October. We'll call it about an 80% chance at the moment in December. it's looking like something of an 80% chance too that we'll potentially see the federal funds rate being lowered by the equivalent of three times, so three 25 basis point cuts, one at each meeting between now and the end of the year. But let's just stick on that voting split, I suppose, Danny, because the way that I am sort of looking at it at the moment is that you've got someone like Christopher Waller who could sort of pull a rabbit out of the hat and vote for 50, noting that, even if slightly unlikely, he has got a recent track record of dissenting. The last decision that we saw was obviously one that saw a dissent from both Christopher Waller and Michelle Bowman. But there's also talk from, you could argue that they're hawkish, maybe perhaps more appropriately, just a little bit more neutral in their approach to policy. Austin Goolsbee, one that has spoken about the upside risks to inflation. And there's also chatter out there, again, albeit an unlikely scenario, that he could vote for an interest rate hold. The effect of that is we've got a lot of dovishness, I would argue, priced into the market. If we get a vote split that suggests a high degree of division, we've obviously also got the summary of economic projections being released at this meeting, and that'll give us the dot plots too, which may show us a greater dispersion of forecasts when it comes to not just the federal funds rate, but maybe even inflation and the unemployment rate going forward. So that might add to a little bit of uncertainty about the future and whether the markets can truly bank on this aggressive rate cutting cycle that, again, as you alluded to before, is basically being discounted into the market at the moment.
Yeah, and it's, as we're saying, it's interesting with Waller as well. Not only is he already pointed towards dovish inclination in the last few meetings, he's also a candidate for the chairman role that will be coming available at the beginning of next year. And it's going to be interesting to see how much political influence we get in this decision, because a lot of talk in recent weeks has been about Fed independence and of course the very politicized and I think legal debate now about the firing of Lisa Cook and whether that's going to be lawful or not, has brought on this uncertainty, this added layer of uncertainty when it comes to pricing in risk in the US about the Fed's independence and whether Trump is going to be the first president in a very, very long time that is going to be able to kind of end that independence and have a significant influence on it. And one of the ways that we could see that is the way that members vote, because if you're in the running to be a chairman, if you want to be considered, you know that Trump is going to be making the decision. He is very heavily focused on the central bank cutting rates. He's been very vocal about that. He's pushed Jerome Powell towards that. And he knows, and I think everyone knows at this point, that Jerome Powell will not be influenced, especially considering how little time he's got left in the position. But that's not to say that the person coming in behind him does potentially want to please that view and could vote to cut rates more heavily than they would have if they weren't in this, I guess, a situation where they're influenced by the running of Fed chairman. So I don't think there's going to be an explicit mention towards that, but I think it'll be interesting to see how markets digest that and whether they believe that potentially some of the dovish voting could be politically influenced.
Yeah, and another, fascinating, actually, two points that I'll make there as well is that we're still, I think, waiting for the Senate Banking Committee, if I'm not mistaken, to potentially vote on the temporary position of Stephen Myron, who's, of course, the head of the Council of Economic Advisors and a Trump acolyte. I think there's still the possibility that he could be effectively available for this decision and maybe a voting member. Keep that in mind, because that will potentially see a 50 basis point move voted for if he can make that in time. The other really interesting dynamic too, of course, is, as you noted, Dani, Powell's tenure ends in about May next year, and although the list apparently has been extended in the last couple of days, there's three loose candidates that people are looking at the moment to take over that chairperson position: Kevin Hassett, Kevin Warsh, and, as you noted before, Christopher Waller, who is on the board. Will we get this situation where, if Powell comes out with his typically cautious and wait and see language, clearly he has changed his tone and outlook on the economy since Jackson Hole and sort of watered down that sort of waiting to see what tariffs do to inflation guidance. However, he's still fairly neutral. There's the risk that he maintains this kind of neutral stance while inflation remains fairly sticky, but he's going to be gone in May. So do we get a situation where the markets price in a Fed under Powell and policy under Powell, which takes a particular shape going into May next year, and then perhaps a much more dovish dynamic on the assumption that well, we could take some cues perhaps from something that Christopher Wallace says or does at this particular decision. Or, of course, the market's just come to assume no matter what, that there is going to be someone a little bit more dovish after that May meeting. And maybe that supports markets to some extent too, even if we get a bit of a hawkish surprise from Powell, knowing that he's effectively at the final stretch of his time as Fed head. But before we maybe go on and talk about the market implications, and obviously then we might tackle the BOE followed by the BOJ, is we've done a lot on the CME Group Fed Watch tool, which obviously we encourage everyone to look at just because it's such a great free resource to look at Fed policy expectations. But one part of the tool that you have at your disposal is looking at where the markets are effectively projecting interest rates to go forward in the longer term versus the previous dot plots. And as you can sort of see here, that red dot is current market pricing. That blue dot is the median projection at the last summary of economic projections that we got in July or June meeting. It might have been June. Nevertheless, there is already a high degree of dovishness being discounted relative to the last summary of economic projections, which again really says that perhaps the bar is set relatively high for a dovish surprise here. And if the risk is skewed in any direction, it's to even a fairly neutral tone coming through from Powell and causing some kind of a snapback in markets that discounts the risk that maybe rates aren't cut as aggressively and policy isn't as accommodative going into the end of the year and next year as is currently being priced in.
Yeah, it could. I guess you could see. I mean, you're right in saying that the way things are priced right now, it's so dovish that the easiest way of seeing a surprise would be a hawkish surprise. I'm just skeptical as to whether Powell, considering how short of a time he has left and knowing that the odds are stacked against him, whether he would be in a position to kind of want to deter some of the market pricing. It could be maybe he wants to stop markets getting too ahead of themselves, but also I think, and Jackson Hole was a great as you were saying, shift in gears that we've seen in his messaging. And I think the labor data that we've seen has definitely prompted that, is the fact that the Fed, specifically Jerome Powell, has been so concerned of repeating their same mistake they did with the hiking period post-COVID, so throughout 2021 and 2022, where they were heavily behind the curve, and that led to such a significant runaway in inflation that kind of hindered growth in the US, although we know now that not as much as feared. But you can also be behind the curve when it comes to cutting, and I think that's something that the Fed has realized. Considering rates have been so restrictive in the US for so long, I do think they had a bit more wiggle room to act before now. And I think Powell has maybe come to terms with that and accepted that that is the case. If you're looking at the case, for example, of the ECB, they've done, of course, such a different set of circumstances. The economy was struggling much more than it was in the US, so they had more enticement to act. But they've come to a point where they were able to cut 200 basis points, which is a lot, and still manage inflation and manage growth. They were able to aid growth and keep inflation from running away. As I said, very different set of circumstances, but markets have been very critical, and Trump and his supporters have been very critical of the fact that Jerome Powell has not been able to move rates, I think, since December last year. At a time when inflation has been dropping, maybe not to the levels they wanted to see, but definitely a disinflation process, and growth has started to show signs of struggle. So I think Powell may have accepted that he's already behind the curve in the cutting cycle as well. It won't damage the economy maybe as much as it was feared in the hiking cycle, but maybe he's not so adamant to kind of prove markets wrong. But it'll be interesting to see, as you say, so much dovishness is priced in, a hawkish surprise could happen.
Yeah, absolutely. Well, it is a good point, and maybe we'll just shift to the charts very quickly about now that we're at this part of the conversation, and kind of pick up on a point that you were just making about being behind or ahead of the curve and where the Fed finds itself at the moment. And my rationale at the moment of basically why the equity market is performing so strongly despite this deterioration in the labor market is that there is that sense potentially that the Fed remains ahead of the curve at the moment. That if it were the case that the markets were genuinely concerned about a recession and a downturn that would impact earnings, say, going into next year, we'd see equity prices readjust to reflect that, especially given the fact that valuations at the moment are rather expensive on a historical basis and wouldn't take necessarily much for multiples to deflate a little bit to reflect a more pessimistic outlook. So there is that sense that really the markets are confident that the Fed is ahead of the curve, that with a few little tweaks to policy, the economy will slow, but they'll be able to engineer a bit of a soft landing, so to speak, and maybe buffer the economy, the labor market from this slowdown. And it's one of the reasons, if you look just at the technicals here, that one, we've got stocks continuing to test record highs. The NASDAQ has been doing so the last week or so, albeit just kind of grinding higher. The S&P 500 is in the same situation where we're just getting that grind to new highs, not far from really 6,600. And although once more, you can sort of knock things on a technical basis because upside momentum is slowing and maybe things are a bit overbought, and on a fundamental basis, things look a bit expensive. Again, that confidence reigns that the Fed's ahead of the curve. The equity market still looks like an okay place to be.
The only thing I will say
Provided,
is, do you think it's ahead of the curve now, or do you think markets are confident that it will be ahead of the curve if it follows the path they've set? And I think that's the key
yeah,
we have to difference.
yeah, absolutely. I think that's exactly the case. Is that the markets are confident that with the direction they're pricing in, Fed will be able to stay ahead of the game, which is where I think the risk lies, is that if we do get any kind of indication that there is not going to be as aggressive policy as being priced in to the market currently, for whatever reason, there might be a misstep in language, there might be a fear that inflation is a little too sticky and that they don't want to be so dovish. The thing that could impact the equity market is if, for whatever reason, that pricing comes out and then there's all of a sudden a belief that the Fed won't remain ahead of the curve and things might be getting away from them a little bit. Your thoughts?
Yeah, no, I agree. I think that the issue with being ahead of the curve is it lies in, what's happening now and what's going to happen in the next 6 months. And I think that's where, as you say, that's where a lot of the risk lies, because right now it's not ahead of the curve. However, if it follows the plan and if it cuts up to 125, 150 basis points from now until March, April next year, then that's when they start to be ahead of the curve. So yeah, you're right that a lot lies on this. And obviously not everything's going to be decided at this meeting, but markets may be looking with a very fine eye to see what exactly they can derive from this. And a lot of it is going to be on the dot plot, on the economic projections, and also on the messaging and the way Powell communicates his thoughts about how to move forward. So yeah, a lot of it rides on, our markets after this meeting, are they still going to be are they still going to accept that what they've been pricing in for the next 6 to 8 months is going to continue to happen? So yeah, a lot of the risk lies there, whether markets believe that Powell and his team are aligned with what they believe is going to happen. In the past, Powell has been very adamant on proving markets, well, not proving them wrong, but slowing down their expectations and being like, maybe you're getting a bit too ahead of yourself. If that were to happen this week, that's, I think, when we see a lot of pullback in equities and we see a lot of that risk repricing, moving away from risk. But yeah, it's just going to be a case of how that evolves.
I just wanted, before perhaps we move on to the Bank of England and then a quick chat about the Bank of Japan as well, I did want to point out just very quickly the kind of maybe confidence slash complacency that markets are experiencing around this event with just the VIX at the
Yeah.
levels that it is. Also, another thing to note as well is we were talking about it in the office today. The implied move for the S&P 500 based on options markets at the moment is about 0.8% around the day of the Fed, which is relatively unusual for a Fed day. So things are lined up for maybe a negative surprise if things don't go to script. So that's just something to keep an eye out for. And again, as you noted before, Danny, it's about whether they reassure the markets that that they are heading in the direction that allows them to stay ahead of things rather than being a little bit too late, which once more is being discounted, that they'll do effectively what's required to protect the labor market and the economy. If they don't, that's when maybe a degree of nervousness comes into to markets, and risk assets start to hit maybe an arguably overdue air pocket. But Dani, do you want to take over a bit of a chat about the Bank of England? Obviously, you're best positioned about that, because I don't believe a change in policy is expected.
No, no, definitely not going to be as exciting as the Federal Reserve, expecting to keep rates unchanged at 4%. The Bank of England is struggling a little bit more compared to the US, in the sense that they do still have rates at a very restrictive level. The economy is struggling a lot more. We had GDP data on Friday showing that the economy did not grow at all in July. So the July GDP figure came in flat, and the 3-month average slowed to 0.2%, which is a metric that's watched very closely in the UK. A lot of that coming from weakness in the production sector. The services sector still continues to drive a lot of the limited growth that we're seeing. But production and construction continue to be sectors that are struggling in the UK. So the GDP data wasn't great on Friday. However, this week, before the actual decision, which always happens on a Thursday, we'll have the labor market data on Tuesday, I believe, and then on Wednesday we'll have CPI. How much of that will have an impact on the actual decision, considering it happens within 48 and 24 hours of the decision happening, is often limited. But it'll be interesting to see, specifically the labor market has been pretty stable. Average earnings, so wages, has been a key area of persistent inflationary pressures in the past, specifically the services sector driving a lot of that price wage growth. It'll be interesting to see whether that can slows or it continues to rise a little bit. And also the unemployment rate expected to remain unchanged at 4.7%, which is a healthy average. And then we have the CPI data. Again, that's going to be closely looked at, because CPI in the UK continues to push higher. In fact, headline CPI remains at 3.8%. If we're comparing that to what we just said in the US, which was roughly 2.9%, significantly higher, well away from that key target from the Bank of England, that 2% target. And again, sticky inflation is driving those fears of stagflation in the UK, which is stagnant growth, evident by the latest GDP figures we've seen, and persistent high inflation, which is unable to come all the way down to target, which is clearly happening in the UK. So the data this week is also likely going to be heavily influencing markets. And we can look at the chart of the pound in just a second more deeply. But when it comes to the meeting, not much expected in terms of rates. Potentially a little bit on the bond policy. I think they're expected to slow the rate at which they have been reducing their government bond holdings. This is obviously the bonds that they bought during COVID to inject the market with liquidity. There may be a little bit of a reduction on the pace of that reduction, but other than that, not really expected from the Bank of England. Governor Andrew Bailey, hasn't really given much away in terms of what he's expected to do at this meeting, or whether anything is going to happen. Markets are pretty much, 98% priced in that there's not going to be much change. So clearly, if there were anything were to happen, would be a significant surprise for the markets. When it comes to the rest of the year, only about 10 basis points of cuts priced in from now until December. So no more rate cuts expecting at this point, with the next rate cut fully priced in for March 2026. So quite a dire situation if you're considering the fact that GDP is struggling, inflation remains high, and rates are not expected to change at all in the next potentially 6 months. So it'll be interesting to see how much reassurance Governor Bailey can give, but also something to watch out for in the UK, of course, is the fiscal situation. We're still a few months away. I believe it's going to happen in November, but of course that budget update from the Chancellor is going to be closely looked at. The fact that GDP has slowed once again is going to be a big impediment to the budget, and especially how much fiscal headroom the government has. But that's something for another day. Bank of England, not much expected. Just watch out for that data. When it comes to the pound, we've seen a little bit of a positive move in the last few days, specifically last week. Pound dollar, as we're seeing on the chart, of course, some of that coming on the side of the dollar weakness, but also against the euro and the yen, we've seen some good moves in the pound. So are we potentially going to see some more upside? I think it's going to be very heavily influenced, of course, by the Fed this week, considering it's such a big event. On the pound side, watch out for that CPI data. At this point, will it be bullish for the pound? When it comes to rate differentials, the fact that the Bank of England is likely to remain unchanged compared to the Fed would be positive for the pound. But again, it plays into the long-term outlook of the UK economy. If that continues to deteriorate, we could see UK assets lose a little bit of momentum, including the pound. So it'll be interesting to pair to watch out. We've got so much happening on both sides of the pair. So it's interesting to see whether it can finally break that resistance there on the top side that's marked on the chart, about 135.9, 136. It's clearly been a short-term resistance there since mid-July. If that were to be broken, today's momentum seems pretty, the week's momentum seems pretty positive, then we could potentially look at the next area above that 136 area towards 137.5.
Yeah, certainly. And it's looking actually quite constructive. So had a couple of cracks at 136. We're close to it now. If that breaks through, then maybe that's a little bit of a technical impetus to run higher. We'll have to see if that sort of rule of thumb holds or not. I'll push on and just have a very quick chat about what we may expect from the Bank of Japan, because I think it'll be an interesting meeting, despite the fact that no move is expected from the BOJ. And that's basically because we did get some leaks to the media and stories coming out about the Bank of Japan's willingness to potentially hike before the end of the year, or at least in the not too distant future, despite what has happened politically in the last few weeks in Japan, and on top of the fact that we have seen a very dovish, relatively speaking, BOJ on this expectation that growth is going to slow, that's going to put some downward pressure on the inflation rate over in Japan, which has remained fairly elevated and has moved away from target over the last few readings or so. And on top of that as well, the dovishness that we did see from the BOJ was very much driven by some of the financial instability risks that are emerging over there, which have been compounded by this view that the political situation in Japan will contribute to potentially lax fiscal policy, basically because the next leader of the LDP might have to run policy a little bit looser to appease some of the minor parties in the Japanese parliament. But it sets things up interestingly, because I think the Bank of Japan is basically behind the curve, and that at some point in time, it's going to have to get a little bit more hawkish in order to get inflation back under control and reassert its credibility effectively, because it's starting, I believe, to lose it a little bit. We've got the Japanese yen trading in a very interesting and tight range just at the moment. You can kind of loosely see it somewhere between 146 and 149 on the top side. Realistically, it's closer to sort of the high 146s to the low 148s. If you sort of zoom out, as one might suggest you should do whenever looking at a chart, and get an appreciation of the trend over the last sort of 12 months for the yen, I do argue that it would be to the downside, and that this might be the meeting that the BOJ, confronting the inflation risks stemming from possibly looser fiscal policy, as well as the fact that clearly it's already inflation's already well above target. A weaker yen could probably contribute to that too, that we might run the risk of a sort of a hawkish pivot from the Bank of Japan this week. No move again priced into the markets. It's less than a few basis points into the curve, but just one to keep an eye out for, because if we do see that hawkish surprise, probably means a stronger yen, probably means a weaker Nikkei, but it also possibly put some upward pressure on global bond yields, which may sort of filter through to other risk assets as well. So just something to keep an eye out there, because that's on Friday. Obviously, the Fed's on Thursday morning. This one could be just the cherry on top, that if we get a hawkish surprise from the Fed, and then, or less dovish, I should say, surprise at a decision from the Fed, and then we get a hawkish surprise from the BOJ, then we might start to see again volatility pick up, which has been almost depressingly low over the last month or so in most markets. But Dani, shall we take it to some questions? We're 30 minutes in now. We'll just sort of run through a few of those if there's any there.
Yeah, well, I mean, the key one before we go off, I guess, is always gold. Always one of the key assets, something that everyone wants to know about. Finally seeing some significant moves over it's been 2 weeks now, maybe even 3. Finally managing to break above that symmetrical triangle we were talking about a few months ago. Seeing some strong momentum. However, we've seen that flat line over the last week, that struggle from buyers to continue pushing higher. I think that's likely on one part a bit of a technical aspect, maybe some profit taking, considering the rally that we've seen in the last few weeks, considering gold had pretty much been stagnant and moving sideways for the past 3, 4 months and struggling to really consolidate a clear direction. So obviously the top side has won out, that bullish drive has continued. The fundamentals remain there, as we've said. However, in that short term, there may be a little bit more resistance moving higher. A lot of it may be having to do on confirmation whether the Fed will actually be as dovish as markets are hoping. We were talking about that, we've talked about it for so long now, but it also affects gold as well, that sentiment coming through as a non-yielding asset. So it'll be interesting to see this week with the Fed meeting what comes from the dot plot and the economic projection and Powell's messaging, how markets take that in terms of does it confirm that expected dovishness in the next 6 to 8 months, and whether gold is able to take further advantage of that momentum into risk assets and also drive it higher, potentially all the way up to 3,700 towards the end of this week if that momentum consolidates.
Yeah, for sure. And it is one of those things that if we do get what feels like an unlikely hawkish surprise or less dovish Fed, then certainly gold, which has really broken out on the basis that the markets were pricing in effectively a cut this week, could kind of cool off a little bit, maybe start to see this sort of retest towards 3,500 too if we do see something of a drawdown. Structurally, a market that's still incredibly bullish, I think, and if you just sort of zoom out, we've been talking about it for, well, I was going to say weeks, but probably months on the webinar, Dani, that things were sort of coiling up, ready to break out. Eventually, it obviously did in a very kind of textbook pattern. But like you noted, we do have some signs of, maybe momentum slowing right now. The RSI on the weekly is pointing to maybe some overbought conditions, and yeah, maybe a relatively hawkish Fed sparks that kind of a pullback. We'll have to see, but that's kind of the dynamic there as we head into the week. We also have just a bit of a question on oil, and fundamentally speaking, I am quite bearish on oil just because what we're seeing in the States is obviously a slowing down in economic activity. We saw some China data today as well that might be worth mentioning was quite underwhelming, especially when it comes to fixed asset investment and industrial production. So clearly not all is not well when it comes to the Chinese economy. But you overlay that with, too, the fact that we had OPEC a couple of weeks ago suggesting that it would increase output again in October. I think the sum is 136,000 barrels per day. I might be mistaken, so don't quote me on the number specifically. But I think the fundamentals are lining up for an oil price that should continue what is its downtrend. What I will say, though, is that we do have some of these indicators of a price that has found some degree of support. I think it's around 62 from memory. There we go, 60 in the low 61s. We'll call it 61.20. That little resistance line at around 64. What we are seeing, though, is a little modest divergence on the daily RSI, which sort of suggests that maybe there's a bottoming process in play. But fundamentally speaking, looking fairly weak just because the demand outlook is dimming. And more importantly, there was already a supply glut building in the oil market. That's only going to be compounded if we continue to see OPEC prioritizing what seems to be a market share drive by most of its or some of its larger constituents. And that will, again, compound this kind of glut that is building in global energy markets.
Yeah, and then finally finishing off with copper. If you pull up the chart, copper saw some significant momentum. I believe it was towards the end of July, beginning of August. There you go on the chart. A lot of this having to do with, I don't remember the exact details, but I think it was something about tariff, Trump threatening 50% tariffs on copper products. I think then that was taken away. So that's why we saw that significant rise in the price and then that drop basically within a space of a day or two as that threat of those tariffs were kind of unwound. Since then, it's been pretty much rainbound, not much of a momentum. The daily RSI has started to climb past that 50 line to that midline, starting to show potentially a little bit more of a bullish attraction into this. But from the technicals, it seems like it's just it's going to continue to drift higher. We've got that the 200-day simple moving average limiting the top side a little bit. It's offered some resistance in a few occasions over the last few weeks. The next area of resistance looks likely to be around that 470, 475 region, which has seen some pause in the past. So yeah, I think technically there isn't a significant setup in copper to go from now. Copper is often used as a barometer of economic health as well when it comes to fundamentals. So the fact that we've got that softening data in the US and also the data that Carl just mentioned from China, again, weighing on oil prices because of the outlook for growth in the global economies, that is likely to have be limiting the moves higher on copper as well. As I said, that barometer of economic health globally.
Well, we may as well wrap it up there, Danny. It's 6:36 my time, so that must be, I think, 8:36
9:37 in the UK.
UK. There you go. So we'll wrap it up there. But wonderful to have your company. Obviously, it's a very busy week on the markets, so hold on to your hats. Join us again next week, or if you want to watch this back or watch past episodes or future ones, if you can't make the live webinar recording or webinar, the recordings are on YouTube. So search up Market Mondays by Capital.com. Otherwise, good luck to you all. And Danny, have a fantastic week.
You too. Bye, guys. Thank you for joining. See you next week.